As of June 30th, 2026, BlackRock managed about $15.3 trillion for its clients. That's more money than the entire economies of almost every country on Earth. Only 2 countries produce more in a year: the United States and China. Your brain was never designed to picture a number that large. Spend $1 million every single day starting today. You still wouldn't finish for more than 41,000 years. But here's the strange part. Almost none of that money belongs to BlackRock. Imagine entrusting someone with your family's life savings for the next 30 years. They don't own your money, but you trust them to protect it and help it grow. That's what BlackRock does for millions of people. Teachers, firefighters, nurses, retirees, businesses, governments, families saving for the future. Today, it serves clients in more than 100 countries, helping manage the financial future of millions of people around the world. Now picture something even stranger. Today, you might use an iPhone, search on Google, shop on Amazon, watch Netflix, drive a Tesla, or ask ChatGPT a question. Behind the scenes, BlackRock manages investments that include many of the world's largest publicly traded companies. Through the funds it manages, it is also one of the largest shareholders in many of them. Yet despite all that, most people have never even heard of BlackRock. Why? How did one company quietly become responsible for managing so much of the world's money? Why did governments and some of the world's largest institutions turn to it during financial crises? And how did a company founded by just 8 people become the world's largest investment empire? The answer begins with a man who almost lost everything. In 1986, a young Wall Street trader named Larry Fink made one decision that contributed to losses of about $100 million. Most people saw it as a costly mistake. Larry Fink walked away with something far more valuable than an explanation. He walked away with a question almost nobody else was asking. The world's largest investment empire didn't begin with a fortune. It began with one of Wall Street's most painful mistakes. In 1986, Larry Fink was not an outsider trying to break into Wall Street. He was one of its brightest stars. A decade earlier, he had joined First Boston when the market for mortgage-backed securities was still young. Fink helped turn that new idea into one of the bank's most successful businesses. The basic concept was simple. Thousands of home loans could be grouped together, then divided into investments that paid people as homeowners repaid their mortgages. But building that market was anything but simple. Fink became remarkably good at it. Over time, his work reportedly added about $1 billion to First Boston's profits. He became the youngest managing director in the bank's history and, at just 31, its youngest management committee member. Some colleagues believed he might eventually run the firm. Fink and his team felt untouchable. Then the market turned. Fink's team had built a huge position based on the belief that interest rates would rise. Instead, rates fell. That alone was dangerous. But the position was not supposed to be defenseless. The traders had also created hedges, investments designed to reduce the damage if their main prediction was wrong. Imagine preparing a building for a flood by placing barriers around every door. Then the water rises through the floor. The protection exists. It simply protects against the wrong danger. When rates moved in a way Fink's models had not expected, the main trades lost money. Then the hedges meant to protect them lost money too. Within 1 quarter, his department was down approximately $100 million. But the financial loss was only the beginning. In an instant, Wall Street stopped seeing a rising star. It saw the man who had lost $100 million. Fink later said he went from being treated like a star to being treated like a jerk. People who once welcomed him reportedly stopped speaking to him in the hallways. Years of success had not disappeared from the records. But on Wall Street, one public failure was enough to erase them from memory. Fink insisted that he was not fired. Other accounts suggest First Boston eventually made it clear that his future there was over. Either way, the outcome was unmistakable. The career he had imagined was gone. Yet the loss exposed something more important than a bad prediction. Fink had believed the danger was understood because the trade had protection. It wasn't. The greatest threat wasn't always the risk everyone could see. It was the false confidence created by believing the danger had already been measured. That was the question that followed Fink out of First Boston. How could an investment firm discover what it did not know before hidden risks became its clients' losses? Losing $100 million had closed one path to the top of Wall Street. It had also given him the question that would define the rest of his career. For most people, losing nearly $100 million would have ended the story. For Larry Fink, it became the beginning of a completely different one. Wall Street remembered the mistake. 2 men remembered something else. 2 influential financiers, Stephen Schwarzman and Peter Peterson, saw something others overlooked. They believed the man who had learned one of Wall Street's hardest lessons might also build something Wall Street didn't yet have. Instead of offering him another trading desk, they backed a new idea. In 1988, Larry Fink and 7 partners launched a new business inside Blackstone. It was called Blackstone Financial Management. Their ambition was not to become the world's largest investment company. They wanted to build a firm that asked better questions before anyone risked a client's money. Most investment firms competed by promising higher returns. Larry believed trust wasn't earned after generating returns. It was earned before risking clients' money. Before trying to grow people's money, you first had to protect it. If clients were trusting a firm with retirement savings, pension funds, insurance money, or public investments, they needed to know that protecting their future mattered just as much as growing it. That single idea quietly separated BlackRock from much of Wall Street. Large organizations responsible for managing billions of dollars were not just looking for people who could make money. They were looking for people who understood what could quietly go wrong. That difference helped the young company win clients sooner than many expected. Money began flowing in. Within only a few years, assets under management had grown from roughly $1 billion to around $17 billion. The business became profitable quickly, proving that caution could be a competitive advantage instead of a weakness. The small team inside Blackstone was becoming one of the fastest-growing businesses on Wall Street. But success introduced a new problem. The more valuable the company became, the more important one question became: who really owned its future? Success had created the very problem that would determine BlackRock's future. The company that had been created inside Blackstone was beginning to develop an identity of its own. Before long, that identity would force both sides to make a decision that would reshape not only their futures, but eventually the entire investment industry. Success solved Larry Fink's biggest problem. Then it created an even bigger one. What began as a small business inside Blackstone was no longer just another division. Clients kept arriving. Assets kept growing. Before long, Blackstone Financial Management had become one of the firm's most valuable businesses. Ironically, the company's greatest challenge wasn't losing clients. It was deciding who would control its future. As the business expanded, different visions gradually emerged. Larry Fink and his partners believed the company needed the freedom to pursue its own long-term strategy. Blackstone, which had provided the original backing when few others would, had its own responsibilities and priorities as the parent company. Neither side was wrong. They simply no longer wanted the same future. What had begun as a shared opportunity was slowly becoming 2 different ambitions. Eventually, both sides reached the same conclusion. The company had outgrown the structure that had helped create it. In 1994, the business separated from Blackstone and became an independent company. Its new name was BlackRock. BlackRock hadn't simply changed its name. For the first time, it controlled its own future. Few people realize today that the world's largest asset manager was once just one business inside another company. If the separation had never happened, BlackRock's story might have ended very differently. Independence accelerated the company's momentum. More institutions placed their trust in BlackRock. More assets flowed through the firm. More responsibility followed every new client. But growth created another problem that few people could see. As BlackRock expanded across more markets and managed increasingly complex portfolios, the number of connections between investments multiplied. A single decision could ripple across thousands of securities, industries, and economies. No team of analysts, no matter how experienced, could track every hidden relationship fast enough. Larry Fink had spent years asking how investors could uncover dangers before they became disasters. Now the company faced a new question. How could anyone understand risks hidden inside thousands of investments before the next crisis exposed them? The answer would not be hiring more people. It would come from building a system unlike anything Wall Street had ever seen. BlackRock had finally become independent. The company now had the freedom to build exactly what Larry Fink had imagined years earlier. But freedom did not make investing simpler. It made it far more complicated. Every new client brought thousands of additional investments to monitor. Every new market created new connections. A change in interest rates could affect bonds. Bond prices could influence banks. Banks could impact businesses. Businesses could ripple through entire economies. The financial world was becoming a giant web. The problem was no longer finding information. It was understanding how everything connected before those connections became dangerous. For generations, investment managers had relied on experience, spreadsheets, reports, and instinct. Those tools had worked when portfolios were smaller and markets moved more slowly. Now they were reaching their limits. Larry Fink believed the next advantage would not come from hiring more analysts. It would come from helping them see what no human could see alone. So BlackRock began building something unlike anything Wall Street had seen before. It would eventually become known as Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. Despite its complicated name, its purpose was surprisingly simple. Imagine trying to direct traffic across an entire country while looking through a single window. It would be impossible. Aladdin was built to give BlackRock a much wider view, helping its team see how thousands of investments were connected, where problems could spread, and which clients might be affected before a crisis unfolded. It asked questions that humans alone could never answer quickly enough. What happens if interest rates rise? What if one country's financial problems spread across the world? Which clients could be affected? Where might hidden risks appear first? The goal was not to predict the future. No system could do that. The goal was to prepare for more possible futures than anyone else. That way, when markets changed unexpectedly, clients would not be seeing the risks for the first time. They would already know where to look. As Aladdin continued improving, it became far more than software. It became the operating system behind many of BlackRock's investment decisions. Eventually, banks, insurance companies, pension funds, asset managers, and other financial institutions would also begin using it, trusting the same technology to help oversee trillions of dollars around the world. BlackRock was no longer building only an investment company. It was quietly building financial infrastructure. That distinction would change everything. Because when the biggest financial crisis in generations arrived, the world would discover that one of the most important tools for understanding risk was no longer sitting inside a government building. It was sitting inside BlackRock, waiting for the moment the world would need it most. When the financial world finally noticed BlackRock, it wasn't because the company had become louder. It was because it had become impossible to ignore. The same philosophy that had helped Larry Fink rebuild trust was now opening doors that had once seemed unreachable. Large institutions wanted more than investment managers. They wanted a partner that could combine experienced people with technology capable of seeing risks across entire portfolios. BlackRock was ready. As the company grew through the 1990s, it expanded beyond its original business, attracting new clients, entering new markets, and steadily increasing the amount of money entrusted to its care. Then came a series of decisions that transformed BlackRock from a fast-growing company into an industry giant. BlackRock understood that building the future would not depend on growing one office at a time. Sometimes the fastest way to become stronger was to combine with companies that already possessed capabilities it did not. One of the first major steps came with the acquisition of Merrill Lynch Investment Managers. The acquisition expanded BlackRock's global reach, strengthened its investment capabilities, and dramatically increased the assets it managed. But an even bigger opportunity was waiting. In 2009, as much of the financial world was still recovering from the global financial crisis, BlackRock acquired Barclays Global Investors. The transaction transformed the company almost overnight. It didn't simply make BlackRock larger. It made BlackRock the world's largest asset manager. The acquisition also brought something else: iShares. At a time when exchange-traded funds, or ETFs, were becoming one of the fastest-growing ways to invest, iShares was already one of the industry's leading platforms. Instead of buying individual stocks one at a time, investors could use many ETFs to gain exposure to an entire market, industry, or investment strategy through a single fund. BlackRock found itself leading one of the biggest shifts in modern investing. Its influence expanded far beyond traditional portfolio management. Its reach now extended across nearly every part of the global financial system. The company's growth was no longer measured only by the number of clients it served. It was measured by the growing role it played inside the global financial system itself. With every major acquisition, BlackRock wasn't simply becoming bigger. It was becoming harder to replace. By now, institutions weren't choosing BlackRock because it promised the highest returns. They were choosing it because it had earned a reputation for helping institutions navigate increasingly complex markets with confidence. That reputation would soon be tested in a way no investment firm could have expected. When fear spread through the global financial system, governments weren't just looking for advice. They were looking for someone who could help prevent uncertainty from becoming disaster. Then came the moment BlackRock had unknowingly been preparing for all along. In 2008, the global financial system suffered its worst crisis in generations. Banks collapsed. Credit markets froze. Confidence disappeared. No one knew exactly which institutions were exposed, how far the damage might spread, or who would be next. For governments and central banks, the challenge wasn't simply stopping the panic. It was understanding it. That was far more difficult. The financial system had become so interconnected that a problem inside one institution could quickly spread across markets, countries, and entire economies. The same problem Larry Fink had spent years trying to solve now confronted governments around the world. They needed to understand where the financial system was breaking and how to stop the damage from spreading. Experience alone wasn't enough. They needed the ability to understand an extraordinarily complex system under enormous pressure. As officials searched for firms capable of analyzing complex portfolios and distressed assets, they turned to BlackRock. Not because it was the largest, not yet, but because it had spent years building the people, processes, and technology needed to understand financial complexity. Its work included helping analyze and manage troubled assets connected to the crisis, giving policymakers a clearer picture of risks that few organizations were equipped to evaluate at the time. For BlackRock, this was more than another assignment. It was proof that the philosophy born from Larry Fink's greatest failure had earned the confidence of some of the world's most influential institutions. That trust did not end with the financial crisis. More than a decade later, when financial markets were shaken again during the COVID-19 pandemic, the U.S. Federal Reserve once again hired BlackRock to help support emergency programs in extraordinary market conditions. That mattered because this wasn't just another client. It was the institution responsible for helping stabilize the world's largest economy. Twice in little more than a decade, it had turned to BlackRock during moments of extraordinary financial stress. The company's influence was no longer measured only by the money it managed. It was measured by the responsibility it carried. With every new mandate, BlackRock moved closer to the center of the global financial system. That growing influence also brought a new reality. The bigger BlackRock became, the more people began asking difficult questions. Was BlackRock simply managing money, or had it quietly become one of the world's most influential financial institutions? Most companies would have protected what they had already built. Larry Fink decided to build something even bigger. The company had mastered traditional investing. The next opportunity was to expand into parts of the financial world where trillions of dollars were still difficult to understand, difficult to manage, or difficult to access. BlackRock began widening its reach, not by chasing every opportunity, by choosing businesses that strengthened one another. One step was the acquisition of eFront, a company whose software helped investors manage private market investments, assets that aren't traded every day on public stock exchanges. Another expanded BlackRock's ability to understand private markets even further. It acquired Prechain, one of the world's leading providers of private market data, giving investors deeper insight into markets that had often been difficult to measure. Then came one of its boldest moves. BlackRock acquired Global Infrastructure Partners, or GP, a firm specializing in long-term investments in airports, ports, power grids, pipelines, data centers, and other critical infrastructure that keeps modern economies running. The company wasn't just investing in businesses anymore. It was helping finance the physical systems the world depends on every day. Soon after, BlackRock announced another major acquisition. HBS Investment Partners, one of the world's largest private credit investment firms, expanded BlackRock's presence in a rapidly growing market where companies raise money directly from institutional investors instead of traditional banks. Viewed separately, each looked like a standalone acquisition. Together, they revealed a much bigger strategy. BlackRock wasn't simply becoming a larger asset manager. It was building one of the broadest investment platforms in the world, combining public markets, private markets, infrastructure, technology, data, and credit under one organization. Its reach continued expanding. Today, BlackRock serves clients in more than 100 countries, supporting institutions and investors across nearly every part of the global financial system. Its influence grew so large that criticism became unavoidable. Some politicians argued BlackRock had become too influential over corporate America. Some environmental groups said it wasn't moving fast enough on climate issues. Others claimed it had become too active in environmental, social, and governance policies, often called ESG, an approach that considers environmental, social, and corporate governance factors alongside traditional financial analysis. Remarkably, the same company found itself criticized from opposite directions at the same time. As debates intensified, BlackRock adjusted some of its public positions while insisting that its primary responsibility remained unchanged. Serve clients, protect their capital, help them achieve their long-term financial goals. BlackRock was no longer just participating in the global financial system. It had become part of the infrastructure supporting it. And that raised one final question. When one company helps manage so much of the world's wealth, what does that really mean for the future of global finance? Today, BlackRock manages more than $15 trillion on behalf of its clients. But by now, that number is no longer the most remarkable part of its story. That money belongs to millions of people and institutions around the world. BlackRock's role is not to own their wealth. Its responsibility is to help manage it. That distinction explains why the company's rise matters. Larry Fink did not build the world's largest asset manager by discovering oil, inventing a revolutionary consumer product, or creating the next social media platform. He built it by solving a problem that almost nobody else was trying to solve. How do you stop risks people cannot yet see from becoming disasters they cannot escape? That question shaped every major decision that followed. That question influenced the way BlackRock managed money. It led to the creation of Aladdin. Over time, it earned the confidence of some of the world's largest institutions. Eventually, it positioned BlackRock at the center of some of the most important moments in modern financial history. In the process, a small company that began inside another firm became one of the most influential financial organizations ever created. Whether people admire BlackRock, criticize it, or simply don't know it exists, one fact is difficult to ignore. Few companies have become so deeply connected to the way the modern financial system operates. Its story is ultimately about more than investing. It is about trust. Because in finance, trust is not built through promises. It is built through decisions made over decades. Some decisions succeed, some fail. Larry Fink experienced both. But instead of allowing one of Wall Street's most painful failures to define his career, he used it to ask a better question. Then he spent the next 4 decades building a company around the answer. Perhaps that is the real lesson behind BlackRock. Sometimes they are the ones solving tomorrow's biggest problems before the rest of the world even recognizes them. And somewhere in the background of the global economy, quietly helping institutions make decisions that affect millions of lives, BlackRock continues writing the next chapter of that story. If one overlooked lesson from a $100 million mistake helped build one of the most influential financial institutions in history, imagine how many other hidden forces are quietly shaping the world around you right now. Together we'll uncover them. Subscribe, and I'll see you in the next story.